Hope everyone is doing well. A couple of announcements. So there's going to be a coaching session tomorrow at 4 p.m. So 15 minutes from right now, 4 p.m. Central Time, 5 p.m. Eastern Time. And that's obviously 2 p.m. Pacific Time. So this is Central Time, 4 p.m. tomorrow on January the 9th. There's going to be a webinar over getting started with the video course. Now, the goal of these webinars in the future is, and it's kind of a pilot. So for the first month, I'm going to be reviewing once a week, basically portions of the video course. So this week and probably next week will be getting started videos. The week after that will be videos over the market cycle. And the goal is to basically go through the entire video course from a standpoint, think of it as a live classroom. And there'll be a format to all of them. So we'll cover the getting started videos, and that's going to really revolve around, if I got Al's video course tomorrow at, what would I do on the very first day? What would I do? What would I do for the first week, first couple of months? How would I get started using Al's information? And then the next piece is going to be, that'll cover the next portions of the course. So market cycle, everything to do with all those pieces. And really, I'm going to go more in depth with the videos. Now, this class is not designed to replace the video course. It is designed to be a supplement, an add-on to the video course. So the expectation for those watching the videos will be to follow along in the video course. So if, let's say, next week we're going to cover the market cycle, my expectation would be that everybody who's going to participate and watch the webinar has already rewatched the market cycle video and the market cycle videos and spent time thinking through it. So it'll be about an hour lecture followed by Q&A and some other topics. But stay tuned. That is tomorrow. I put the webinar link. Give me 1 second. I put the webinar link in the, let me just check something right here. I'm going to turn the screen off, but you can still see me. The webinar link is actually, you should have gotten an email for the webinar link. And aside from that, there should be, we'll see if we can put it on the Brooks trading course, but the link is actually, I put it in the comments just a few minutes ago, and I'll see if I can add it again. So here is you should have the webinar link right here. So if you scroll up in the session, here is the webinar link. But anyways, that will be tomorrow, and it'll be recorded. It'll be recorded and put on YouTube. So a lot of interesting things going on here. On the daily chart, a few things. One, we finally reached the moving average over here. And my one thought with the moving average was, I thought there'd probably be buyers at the moving average. In other words, all the bulls who were wanting to buy closer to the moving average, they started buying here. And then the market got far from the moving average. We had the outside down bar on the 20th of December. My thought here was the market was in a trading range and traders wanted to buy closer to the moving average. And eventually, if the market continues to stay away from the moving average, what is everybody going to do? they are going to end up moving limit orders. In other words, they'll pull their buy limit orders and drag them down to the moving average. And that's what happened right here. We had a bear bar, gap down, another gap, bear bar closing on its low. But is one bear bar closing on its low really enough to undo all of this damage? Of course not. And that is exactly why the market started to hesitate. Now, if you're a bear, though, if you're a bull, why not just buy at the market right here? Some will, and you can see that's why the bar rallied. But one of the concerns for the bulls is momentum. If you get a bear bar, kind of like over here, we gap down to the moving average, bull bar, outside down, 2 or 3 bars below the moving average, another outside down bar, and the market continued to stay below the moving average. And then it led to a further sell off. That was the concern for the bulls. But the reality is, very tight channel. And once the market started to go sideways and fail to get a downside breakout, what did everybody start doing? They started buying. So the bulls, some of them step aside on the way down. We get overlapping bars over the past 2 days, and traders decide and they conclude that this is not enough to make the market always in short. And that's why we got this bull bar. One of my concerns, I mentioned that I think the bears are going to get a second leg down from this sell off. I mentioned that in the past couple of blogs, but also said that one of my concerns right here is whenever you're selling, it's really dangerous. You can think of this as a small pullback trend. And whenever you're selling right at the moving average, which is obvious support, and you're selling above a bar, sometimes you'll get a surprisingly big breakout bar that traps you. So the bears, if they sold, let's say they sold above January the 5th, so basically last Friday, if they sold above it today, look what happened. Really big bar. I think this bar is strong enough we'll get a second leg. It's a trading range. We've been in a trading range for several bars. We're in the middle of the range. And because of that, traders are deciding, what is the follow through going to look like? Strong enough bar. I think it's a surprise, and we probably will get a second leg. So what does that mean? I think we're probably going to do, something like this, like this. In other words, I don't think that tomorrow is going to be a big bear bar. But with that said, I want to show an example. Maybe I can find it. Here's an example. So we had, this is the euro dollar on a daily chart, and we had a rally and a big sell off, and probably sellers not far above. And we had a big bull bar. It's a strong enough surprise that the market probably will go at least a little bit higher. But one of the concerns for the bulls is that there's sellers above. The bulls got followed through here. And if you remember this bar, the next bar ended up being this really, really big bear bar. And if you remember, this big bear bar right here actually took a long time to form. So when this bar closed on the daily chart, the next several hours, if I remember correctly, it went down and pulled back a little bit towards the close. But the point is, after bars form in percentages. So if we think about a daily chart, there's 24 hours in a day. If the market's open for, let's say, 23 hours within the day, that means you can divide the bar up into percentages. So after several hours have gone by and the market has not gone anywhere, it's similar to a 5-minute chart. If you're buying a breakout in the fourth and you're 4 minutes into the bar and the market hasn't gone anywhere, that increases the chances that more and more traders will take profits. And that's what happened right here. So the daily chart, how do we tie that back to the daily chart? We have a big bull bar, and it'll be interesting to see. Will tomorrow gap up? Will we immediately get follow through, or will we get a trading range bar? Big bar, big risk in the middle of the range. That makes me hesitant to say it's a buy the close bar. I do think there's sellers not far above. Now, what do you think I'm going to say about right here? Look at this. Remember what I said sometime over here? I said we were approaching this price level, the March 2022 high. And because of that, we're approaching the March 2022 high. My one thought was we were climactic and far from the moving average. And because of that, I thought the market might have to pull back and test the moving average and then get up here. Well, guess what? We've went below the moving average. So we completed the objective or in the need for the market to pull back. Now we have an obvious magnet right above. So if you think about the perspective of markets and magnets, everybody sees this right up here. And if you're a bear and you want to sell, do you really want to sell the close of this bar when maybe a measured move up of the bar takes you right to the March 2022 high? That is the concern for traders. The other concern, let's just see if we can zoom out a little bit more. Here's the weekly chart. The next target is that's the March 2022 high right here. The next target is obviously 5,000, 5,030.25, which is the high of the all-time high. And that is obviously far away. So are we going to get to 5,000 without pulling back more? Probably not. I think we're in a trading range. But as far as how do you take this information and apply it for tomorrow? Probably going to have a disappointment bar. I do not think we're going to get strong follow through, but with the magnet really close to it, I do think we're going to get up to the March 2022 high. It just makes sense. And there's really two targets right here. You have the March 2022 high, and you've got the basically last year's high, December the 28th. So December 28th, the high of last year, 4839.75. And we're basically 40 points away from it. And when you have big bull bars closing on their highs, it's hard to see it because we don't have obviously we do not have a yearly chart, but we can think through what a yearly chart would look like. So here's the low of the year, low of 2023. Here's the high of the year. So picture here to here as one candle, just one bull bar closing on its high, and ask yourself, what's the probability? Do you really think that the market is not going to go one tick above this high? Of course it is. Chances are probably really high that we're going to trigger the buy above December the 28th, even though it says December the 29th. So I think we are going up here. But this is a warning for the bulls on the daily chart. This is a warning for the bulls that the market's is entering into a trading range. But trading ranges are often minor reversals and lead to sideways trading. Give me just 1 second. So, anyways, we're in a trading range here, and we could easily get a measured move up right here. So tomorrow will be important. It'll be important to see what kind of follow through we can get. Someone made a comment that this is the first time that we have not touched the EMA, the 20 EMA, in an entire day. There are other days that have touched it, but obviously, any day that fails to reach the moving average is obviously an incredibly strong day. And because of that, obviously, you have to respect it. You can see right here, the low of this bar is 60.5, and the moving average is 60.38. So, you know, That is, you can argue, technically, according to TradeStation's data, we didn't touch it. But either way, if you have to zoom in that much to decide if the market touched the moving average, that's an incredibly strong trend day. So certainly a statement by the bulls. Now, what do you expect? If today was unable to reach the moving average, what do you think the probability is tomorrow is going to be another relentless strong trend day? That is going to the odds are high you're going to be in a climactic it's a climactic rally, and therefore the market's probably going to be sideways. And to clarify to the person's question or the person's comment about not touching the EMA, yes, as far as when I say the market has, there's probably a day we can find where the market has done this before, where it has not touched the EMA. But the point with that is they're very hard to find. And if you just simply open up TradeStation and start scrolling to the left, it will take you a very, very long time. So obviously, this is a very relentless day. As far as out of how many days, out of how many days does the market not touch the EMA? It's probably 1% of days, if I had to guess. Someone says, wouldn't a strong trend day increase the probability of follow through? Yeah, it does increase the probability of follow through. But my comment is climactic behavior. So I think the market on the open is probably going to go sideways. In other words, I don't think tomorrow is going to be another strong trend bar. What I think tomorrow is going to be is something disappointing, like a weak doji bar, something like this that leads to a second leg up. So we'll get a rally today, pause tomorrow, second leg up, maybe Wednesday. Whenever you get these kind of days, it's never clear on the open. You get a trading range open, you look to the left, there's a lower high from yesterday. You get a bull breakout on 6 and 7, but 7 has a lot of overlap and it goes sideways for 4 or 5 or 6 bars. Climactic bar on 13, sideways for 2 bars. Biclimax 16, big bear bar. And it's easy to look at this and think, yeah, it's a parabolic wedge. 1, 2, 3. Therefore, this has got to be the high of the day, right? No, not necessarily. It is a parabolic wedge, and that does increase the probability of 2 legs and a possible endless pullback. So parabolic wedges, you can get them 1, 2, 3, where the market just channels. It starts to drift something like this in a very tight channel. And then sometimes you get a downside breakout. But overall, parabolic wedges are minor reversals, which increases the probability that at the best the bears can get is a sideways trading range, followed by an upside breakout and trend resumption. And you can see we got small 2 legs down, 17. This is kind of what I think might happen over the next few days, except it's an inverse. Big bear bar, so bear breakout bar 17, pause 18, and then second leg down 19. Bull bar, pause tomorrow, second leg up maybe the next day. So this is 2 legs down, and that's the minimum needed for this. Strong enough sell off, probably a second leg down likely, but when you're in a tight bull channel and you sell above bars, you can see maybe that's a third leg down, but you can see that bulls quickly started to get trapped and the market grinded its way up and then it broke to the upside and continued to rally higher. So anyways, let's start with the day. First bar of the day, bull bar closing on its high. Strong enough bar, we'll probably get at least a small second leg up. Are we always in long? I think so. But in general, I like to wait for consecutive strong bull trend bars, at least one closing on its high and the other closing above its midpoint before saying that the market's always in long. We're right in the middle of a trading range, and that will increase the probability that the market goes sideways. Another thing to mention that I forgot about is look at the 60-minute chart, and what do you notice? We have a trading range open here. We have a spike, pullback, second leg down. So a spike, pullback, another leg down, or a spike, pullback channel. This is a channel, and that's the main point that I'm making. And when you look at this channel, a lot of overlapping bars, big bull bar, another leg down, 2 or 3 bars here, big bear bar, follow through, more bars, sell off here, big outside up bar, downside breakout, more sideways trading. This looks like whenever you have limit order bulls making money below bars, eventually, the odds are stop order bulls are going to make money as well. And that's what happened here. Now, in general, what I always talk about with moving averages, if the market's below a lot of bars in a moving average, that means you're trending. You're in a trending environment. So here, we're in a bear trending environment. Now, it's not very strong because when you look at the bear trend and you look to the left, these were the only bars actually below all of this right here. So it looks like a leg in a trading range. And usually, what I like to look for is a breakout bar similar to here, closing above the moving average, and then follow through for 1 or 2 bars. Bulls getting follow through above the moving average greatly increases the probability that the market's going to go higher. And you see what happened. Climactic bar, more follow through buying. Now, as strong as this rally is this clearly going to lead to an upside breakout? No. We have a strong rally, and look to the left. We're in a trading range. Trading ranges are notorious for obviously disappointing traders. And one of the places we could rally to is up here. Now, the fact that we have this many bull bars we have 1, 2, 3, 4, 5, 6, 7, 8 consecutive bull bars in a 9-bar, really an 8-bar bull micro channel. That's climactic, and it increases the probability that we're going to pull back. But the odds are whatever pullback we get will be bought. So there's probably buyers below the first reversal scaling in lower, and we'll get a second leg up. And I think we'll probably have to test up to here at a minimum, the 48.23 area. But overall, like I said, we're going up. I think we're going up to the December 28th high. I don't know if we're going to do it on this run. We may break out, go sideways, pull back, then try and go up. But I do think we're going there. First bar of the day, bull bar, but rather see follow through in a small follow through bar. So think about this for a second. You have a really big bull bar on bar 1, and bar 2, you have a weak follow through bar. If bar 1 was such a high probability buy, why is it that the market, if bar 1 was such a high probability buy, why is it that bar 2 is such a small entry bar? In other words, if there was a lot of momentum buying with bar 1, bar 2 would be a strong entry bar. It'd be a second strong bull trend bar, but it's not, and that increased the probability of more sideways trading. But chances are probably buyers below 2 scaling in lower for a second leg, and that's why 3 has a big body. 3 broke below 2, bulls bought the 2 low and more lower, and you can see what happened on 4. We went 1 tick above 3 and pulled back. Therefore, as weak as bar 2 was, it was strong enough for a second leg up. Bar 5, bear breakout, but weak bar increases the probability. It's a bear breakout bar, but it's not closing on its low. Increases the probability of buyers below. Tight trading range, therefore probably going to pull back to the moving average. And then bar 6, we have a bull breakout of a tight trading range, getting follow through, still always in long, but becoming parabolic. 1, 2, maybe 3, but 6 is enough of a surprise. I suspect we're going to go at least a little bit higher. 7, follow through buying, but a deep pullback. We tested the 5 high, the breakout point. We went below the 4 high breakout point and reversed up. With the tail on 7, that makes me think that instead of buying the close of 7, the market may have to pull back a little bit and before it goes higher. But consecutive bull bars, 6 and 7, probably buy the close and buy more lower. And that's what I was talking about with 8. 8, you can see traders sold the close of 7. We rallied on 1 and 2, deep pullback on 3. We rallied on 6 and 7. Probably going to go sideways for at least a few bars. 9, breakout below 8 and a close below 8. Good for the bears, but relatively tight bull channel. Possible lower high with Friday's 21 high or 22 high. And because of that, we may have to test lower to the moving average or even the 78 high. Even the 78 high, but 2 consecutive bear bars. I think the bears probably need one more big bar to make the bulls give up. If you bought the close of bar 7 here and scaled in lower, you've not had a chance to get out break even after the disappointment on 8. Bar 10, reversal up, high one buy, probably sellers above. And that's why the market pulled back during bar 11 and then rallied again. But tight bull channel, probably sellers above and buyers not far below. 12, second leg up after 10. The market rallied, paused on 11, got a second leg up 12. But I suspect there's sellers above scaling in higher. We have a possible open gap right here. And you have to think about possible measuring gaps, maybe something like this, or the first one, low of bar 1, gap, second leg up to here. And you can see next bar on 13, you had the bears getting trapped. Bears sold the high 1 or the high of bar 8. They got trapped on the bull breakout on 13. 13, surprise, probably going to get at least a second leg up. Is it by the close? I don't know. It might be. My concern with buying the close of 13 is it's the best looking bull bar of the rally. And look what's happened after on these big bars. Big bar 1, sideways for 4 bars. Big bar on 6, sideways for 4 or 5 bars. Now we have a big bar on 13. So when you get a move up and then a pullback, move up, pullback, move up, pullback, it creates a parabolic wedge. 1, 2, 3. So I suspect that 13 is going to have bad follow through. And you can see 14, it's an inside bar. It's a trend line break of 13. Probably going to retest the high of 13. But there might be more sellers above 13 than buyers. And you can see 15 testing the close of 13 and trying, and the bulls are deciding what to do. High one buy above 16, but probably sellers above. And instead, guess what? 16 led to an upside breakout. So we have a rally, pause, breakout, 12, 13. 13 strong enough for a second leg up on 16. And now we have a more defined wedge, 1, 2, 3. What about buying the close of 16? I would not. When you get parabolic moves, usually the market gets a pullback. And that's what happened on 17. 17, almost an outside bar. But as soon as 16 closed, traders sold the close at 17. For the bulls, I would certainly get out of longs below 17. Too much risk that we get 2 legs sideways to down. And for the bears, as far as selling below 17, you're taking a low probability trade. Bear bar closing on its low in a tight bull channel, but it is a credible parabolic wedge, and that will increase the probability that the market goes more sideways to down. And then we got a bear bar on 18, but a weak entry bar. A lot of bulls, if they sold below 17 and they see 18 as their entry bar, they still expect a second leg down, but they're disappointed with 18 and they may just try and scalp out and take whatever they can get. If they sold below 17, they were hoping that 18 would be a strong bear bar, similar to something like this. They were not hoping 18 would be this. Now, is it possible that 18 could develop this and get an endless pullback? It's possible, but over here, we had a climactic rally and then sideways for several bars before we sold off. Here, we have climactic rallies, but we're not really going sideways. We're still channeling up in a very tight bull channel. If you draw, here's the channel, and you can see obviously it's very tight. And more importantly, if you pull this up on a higher time frame, it's a breakout. So if you look at a 15-minute chart, let's look at 10 o'clock because that's a round number. 10 o'clock on a 15-minute chart. That is, if you're selling here, you're selling this right here. Do you really want to sell? You probably can't see this. Let me just move this up. Do you really want to sell below this bar closing on its low? Of course not. Tight bull channel, probably buyers below scaling in lower. Follow through 19. Strong enough sell off will probably sellers above in a second leg down. But tight bull channel, if you're selling the close of 8 of 19, you're selling really, really close to support. And support could be the moving average, but it could also be the 14 low and the breakout point, the 12 high or the 8 high. And that makes me think that the market's going to go more sideways here. You can see what happened on 20. Instead of 20 going straight down, the market rallied to above the 19 high. And bear strong trends or strong breakouts do not get a lot of overlap. And because of that, do you really want the breakout bar itself, bar 19, getting this much overlap? You can say, well, there was a lot of overlap here. That's true. But look at 23 and 24 and compare that overlap to the overlap of this breakout bar. Yes, bar 22 overlapped a lot of bars to the left, but after the close of 22, there's very little overlap as far as the range of bar 22. Here, this is the breakout bar. We overlapped the range of the entire breakout by 50%. And then we had 100% overlap of the 19 close or the range of 19. Both of those reasons increase the probability that there's buyers not far below. And you can see what happened. We tested the low of 13. 13 low, 54 and a quarter. The low of 24, 54 and a half. So there were buyers one tick above the 13 low. Now, why did 54 trigger the sell below 53 and, excuse me, I said 54. Why did 24 trigger the sell below 23 and 22 and bounce or reverse up? And the answer is simple. Bears, they sold the close of 19. They were disappointed by the follow through on 20. And they were disappointed by the follow through on 20 because instead of 20 being another strong bear bar closing on its low with little overlap, the market went up on 20. So bears, they sell the close of 20, scaling higher, and they get out break even or below it. 21, 22, follow through buying increases the probability that the market is going to go. Follow through buying, bull bar closing on its high, increase the probability that the market's going to rally for a couple of legs. 23, doji bar. Do you see what happened? The market rallied to the midpoint of bar 16 or 17 and then turned down. But there's probably buyers below the 23 doji scaling in lower. But obviously we're in a trading range and we'll probably go sideways for a lot of bars. What about selling for a swing? I would not. If I'm going to sell, I really want to see the market break strongly below the moving average. I still think we're obviously in a trading range here on this whole day. And we broke above yesterday's high, which is last Friday's high right here. So we're right at support, right at resistance, the high of last Friday. And we're trying to break above it, but this channel's tight. It'd be better if we're going to get all the way back down to this lower high right here, which is fairly common in trading ranges. If we are going to do that, there's going to be plenty of time. But right now, I really am hesitant to be buying. I'm really hesitant to be selling all the way up here when I think the market's going to pull back. But in order for the market to pull back, we need to see more selling pressure, such as getting below the moving average. 24 inside bar, same thing, buyers below, sellers above, breakout mode. 25 breakout above 24, but still in the trading range. 26 doji, 27 bull bar. What do you notice about the rally from 21 to 27? We're getting bull bars closing at or above their midpoints, and we're getting bear bars closing really at or above their midpoints, and the bears are failing to get bars closing on their lows. Increases the probability that we may rally to the upside. Because we had a parabolic wedge, it's a breakout on a higher time frame. The market may have to go above this high. 24 corresponds to the second hour of the day, and you can see that's the first hour. Here's the second hour. 62 and a 0.5 is the high of the second hour. that means it's a stop entry buy on the 60-minute chart. And because of that, it's a magnet and we're probably going to trigger it. And you can see we triggered it. Looks like we triggered it on the very next bar. So 28, trigger the buy above 16 on the 60-minute chart, pulled back. Parabolic wedge, but minor reversal. What about buying below 28? You can, but it's just above the moving average, and there might be more sellers below 28 than buyers. But if there are buyers below 20, but while there might be more sellers, while 28 may have to pull back, I suspect there's buyers not far below. So it's really difficult to be selling here and making the math work. And you can see instead of sellers below 28, there were buyers. For the bulls, high one buy, but probably sellers above and more sideways. And you can see what happened. We had a high one buy, and it's hard to tell. Can't tell from this chart. We'd have to look at a smaller chart if we actually triggered the buy above 29 and then reversed down. But this is really relatively common. We triggered the buy as soon as 30 closed. The market went below 29 and then reversed up. So now we have an outside bar, possible bull breakout of a wedge, or you can just call it a bear flag. So we have a bull breakout above a bear flag, possible measured move up. Next thing the bulls need is decent follow through. They can get decent follow through by preventing a lot of overlap here. And you see what happened on 31. As soon as 30 closed, the market immediately went up. And that's a sign of buyers, and that's a sign of a possible open gap. Now, what about buying the close at 31? You're buying right here, which is, let me see what this is. I'm going to delete that. That is high of a few days ago. Here we go. So as far as buying up here, you're buying a tail above a bar relatively late in a tight bull channel. So there's probably more sellers above than buyers, but I suspect the downside is probably limited. And we may test back to the 28 high or even the 29 high, but I suspect the downside is probably going to be fairly limited. 33, overlap, inside bar, and then a bear breakout below 33, broke below 32. 32 is an inside bar. We may get a few legs sideways to down, but probably going to go mostly sideways here. 34 broke above the 33 high and reversed down. But you can see we didn't break that far above it. Chances are probably sellers above 33 and more sideways trading than straight up. And that's what happened on after 35. So 34 broke above 33, high one, found sellers. And then you can see 35 broke to the downside. Now, is 35 enough of a surprise that we'll get a second leg down? 35 enough of a surprise that we'll probably get a second leg down? It is a surprise bar, and that increases the probability of a second leg down. But tight bull channel, this is a trend line break, which means it's a second leg down in a bull trend or trading range. And until we break below major major higher lows, chances are buyers below scaling in lower. 36, bad follow through. So we have a tail on 35, bad follow through 36 for the bears. Chances are buyers below and will probably go more sideways. 37, upside breakout, trapping the bears who sold the 36 high and more higher. Retesting the closes up here. And then you can see 38 follow through buying. What about buying the close of 38? Some traders might, but you're buying high and with a lot of overlapping bars. And there's probably more sellers above scaling and higher. Now, a lot of bears, rather than selling the close of bar 38, a lot of bears would rather wait and see bad follow through on 39 and 40. 39, bad follow through, but strong enough breakout. 37, 38, probably a second leg up likely, but I suspect there's sellers above 39 scaling and higher. 40, overlapping bar, probably sellers above scaling and higher, but As far as a stop placement, you probably need to stop somewhere up here. And that's why 50, 41 upside breakout, surprise, but probably going to pull back to the 38 high at a minimum. And you can see that's what the market tried to do on 42. There were some buyers back at the 40 high, which is why 42 sold off and bounced. But 41, the bulls who bought the 41 close disappointed 42. If they're long and scaled in, they should, and they probably will. They will probably look to exit around the 41 close. $43 inside bar breakout mode. We're still in a tight bull channel, but chances are we're probably going to get closer to the moving average. And then 44, we broke above the high 143. But every time we keep going above bars, we pull back further. And that makes me think that we're probably going to pull back within a bar or two. And you can see what happened on 45, second leg down. It's a smaller version of this right here, 33 to 35. 45, surprise, may get a small second leg down, but it's really a small bar. And bear bars within a tight bull channel usually lead to sideways trading. So as far as selling down here, that's probably an unwise choice and not ideal. Small bar, 46, but probably going to go more sideways. And you can see 47, more sideways trading. 48 outside down with 47. So we had an outside down bar. We had an outside up bar, 47. Let me just make sure that's true. Outside up bar, 47. It's actually not. It's an equal low. And then we went outside the prior bar. And then we went outside down, 48. 48, maybe enough of a surprise. We get a small second leg down. We have several reversal attempts, and that will increase the probability that the market starts to pull back. But overall, tight bull channel. Better to wait and see what the trend line break looks like. Just like Al says in the video course, better to wait and see a major trend reversal setup before counter trend trading. 49, bears unable to trigger the sell, and bulls immediately bought it, leading to an inside bar 49, but probably sellers above, scaling in higher. And then 50, bears just sold to close at 48, disappointed 49, getting out break even. 54, breaking out above 53. And 55, another breakout bar, closing above the 44 high. Consecutive bull bars may go a little bit higher, but again, we keep closing breakout points. Broke above 31, pulled back here. Broke above these highs, but this gap might be open. And because of that, traders will wonder, are we going to get something like this? And then 54, follow through buying. So possible another measuring gap in an already climactic day within a small pullback trend. 54, climactic bar, so it may start to go sideways fairly soon, but not all that clear. And then 55, doji bar, probably going to go more sideways up here. 56, close at the 55 high, still channeling up. And again, without a trend line break, something breaking this bull trend line. Without it, chances are we're probably going to go more sideways. And then 57, even bigger bar. Getting really close to the open of the year month. No point in having all that. Getting really close to the open of the year. The green line. Climactic bar 57, so probably will yield some profit taking. For the bulls, for the bears, they'll see it as a bull breakout of a channel. I'm going to remove these lines. So the bulls are hopeful it's a failed breakout of a channel, and then we reverse down within a bar or two. Whenever I'm trading, I always want to keep distance. I want to see white space above, and white space below. So I'm never trading. When I'm trading, I don't ever trade like this, because this psychologically can make you think that you're going to get a top because you're at the top of your screen. Therefore, the market's got to pull back. And that's just not true at all. So, whenever the market's trending in any way, I always want there to be space. So, sometimes I'll drag this down just to remind myself that we can go up a lot further than I think. 58, bad follow through. So, probably going to pull back soon. Now, as far as pullbacks go, if you're a bear and you sold the close of 57 or you sold the close of 58, the scalp is often the midpoint of the bar. Sometimes it's the low of the bar, but a lot of times it's just the midpoint of the bar, and it's a quick trade. And you can see here we haven't even tested the midpoint yet. Bar 59, high one buy, probably sellers above and at least a small second leg down. But look what happened on 60. Instead, we got a second leg up. You see the issue with selling the close of big bull bars on a day like today? It's really tough. 57 is a climactic bar, and therefore reasonable probability to assume it'll get its own second leg up, which is possible. It's possible 60 is that second leg. And because of that, I suspect there's bad follow through on 60. And then 61, look what happened. Instead of getting bad follow through, the market got strong follow through buying. Because of this tight bull channel, the reason bulls are able to buy here, and even as the market's continuing to go higher, is you'll have some bullish institutions buying and scaling in lower on any pullback. And because of that, they really don't care. As long as the market's continuing to trend, they'll buy and buy more on the pullback. 62, inside bar, reasonable for bulls to take profits if they're still long and wait to buy a pullback. 63 broke above 62, and 64 follow through. And then you can see, obviously, we continue to rally on 65, 66. 66, another wedge, possible wedge, but really not all that clear. 67, high one buy. There's probably sellers above, but still bulls buying below, scaling in lower. And you can see there were sellers above 67, and it led to a test of the 67 low. 69, consecutive bear bars. 68, 69, but it's the first consecutive bear bars all day. And the Bears have really been unable to make money below any bar all for really almost the entire day. And when I say below any bar, I mean below any credible bear bar. Sell below 17. If your risk is the high of the bar, you made barely 1 times your risk. But if you sold below any of these bars, I get it. If you sold below 34, put your stop above 34, you made more than twice your risk. But the reality is, who's going to sell below 34 and then put a stop above 34? It's just really the risk reward's small, and it's not ideal. And because of that, I'm leery about selling anywhere up here. Better to wait for strong follow through selling. And you can see 70 reversal up. The bears need to stop the buying and make the market go sideways. Then they need to make the market go below the moving average. This is kind of like an extreme version of the daily chart. How the market needed to stop, the bears needed to stop the buying and make the market go sideways at the moving average first before they can think about a bear trend. Here, sideways to the moving average, but they now they need to make the market continue to go sideways and then start getting closes below the moving average. Then, after that point, the bears have a chance at a major trend reversal. So it's the same logic here. 70 bull bar. There might be more sellers above, and we'll probably go sideways to the moving average. But again, it's all minor. The bulls on a day like today, they can pretty much buy anywhere, scale in, and make money. So even if you buy the close of 70 and just buy more below 70 and more at the moving average, you're probably going to make money. 71, bull bar, inside bar, you can call it a high one buy. And then, of course, no surprise, 72, outside down. High one, late in a range. It's retesting the high of 70, gets second leg down. What about selling below 72? Probably not. Bears, again, unable to make money below any bear bars. And then 73 reversed up. And then we got a surprise breakout, 74. but it's the best looking bull bar of the entire rally. I suspect probably sellers above, and we'll probably test the breakout point 73 high and probably test the 74 low at a minimum. Bulls buy the close at 74, disappointed at 75, and you can see what happened. They never had a chance to get out break even. But as strong as 75 and 76 are, I still suspect we're going to go more sideways than straight down. And because of that, would I sell the close at 76? No way. If anything, if I sold, which I actually did sell the close of 74 in a situation like this, and my reason was it's very common for the market, whenever you get a strong bull trend, it's very common for the market to get profit taking late in the day. So in situations like this, if I sell the close of 73, I often just put a stop around a measured move up at the bar. And my plan is I'm willing to scale in lower, but I really do not want the follow through to be a bull bar. I want the follow through to be a disappointment bar. In this case, it was a disappointment bar. And then I got out in the bottom third of the bar. I don't remember if I got out at the low of 74 or around the open of 74, but I got out somewhere in there. And then I didn't do anything else. But big enough bear bar, I didn't do anything else for the rest of the day. Big enough bear bar, you may get a second leg down. But big bear bars, again, think about it like this. It's the first time the bull's been able to buy close to the moving average. This may find buyers instead of sellers. And that's why a lot of traders, if they're selling above bars, they're scalping. Nobody wants to buy below bars. Big bull bar, 77. I think it'll probably go sideways to down fairly soon. And then there's the rally on 81. Obviously, really interesting day. Clearly, always in long. And because of that, because the market is clearly an always in long day. And because of that, that increased the probability that the market, you could really buy and scale in lower and make money doing just about anything. Stop entries, any bar closing on its high was a stop entry on a day like today, especially if you can use a wide stop and scale in. So if you buy above one, you trust your stop below one. As far as always in, traders buy above one. Where do they get out? Some would get out break even in here. If they didn't, technically they don't have to get out below 8. I would certainly get out below 17. Aggressive bears might sell, but it's minor because of the wedge. If you sell below 17, if you sell out of longs below 17 or sell to go short below 17, you've got to buy back your shorts on 22. And it's also a minor reversal. So a lot of traders are anticipating it failing. Bulls buy above 22, bears exit shorts. And where do they get out? I don't know. You can get out anywhere up here, or if you want, you can hold betting on a small pullback trend. Pretty tough to do. And where do you get out in here? There's really not a reason to. But when you look at this during that time, tight bull channel looks relatively disappointing. Possible gap here, gaps here. It's okay to hold. And then, where do you get out? Not really easy. For me, if I was buying, if I was long above 37, I'd probably put a stop down here. And then through here, if I was long, I'd probably just keep a stop below, maybe a point or two below a strong bull bar. And then once you start going up like this, start moving your stop a couple points below any bar. And then let me drag the chart down. Where would I get out? Maybe below 72, with it being so late in the day. I'd certainly get out below 75. But it's really, it looks easy when you print the chart out at the end of the day. You think, of course, I buy above 1. That's minor, so you don't get out there. Or you get out there and you buy above 22, and then you hold long. All of that makes sense. But really, really tough to do real time. Give me just a moment, and I'll talk about questions. And by give me a moment, give me about 3, 4, or 5 minutes. But I'll be back in a few. So for limit orders, if most bull bars were good stop entry buys, and the problem when I say good stop entry buys, whenever you have a tight bull channel, the reason they're good stop entry buys is you can buy just about above anything and scale in lower and make money. It is not an easy stop entry buy. If you look at it, if you look at this chart as a whole, most stop entries were actually terrible. If you buy above 6, you get a pullback. If you buy above 13, it goes sideways. If you buy above 22, that's good, but it's not clear. Possible wedge top. You buy above 30, it goes up for a bar or two, deep pullback. You buy 37, but not clear. You're in the middle of the trading range. But the point is, the key is realizing that the market is above the moving average in a tight bull channel. And until the bears break strongly below the moving average, the market's going to go mostly sideways. So for limit orders, it's basically a buy below anything. You can scale and lower and scalp. And a lot of traders, that's what they do. Rather than buying bull closes, they see the overlap here, they see the overlap on 7, and they buy below bars. So instead of buying the 7 close, wait for a bear bar and buy below it, or buy on a limit order in the middle or bottom third of bar 7. Let me take a look at questions. Okay, what's the probability of a head and shoulders top forming on the daily chart? So a head and shoulders top is just a lower high major trend reversal. And right now, as far as a head and shoulders top right here, I don't think it's all that high. Most head and shoulders tops are minor, really should be trend continuation patterns and not successful reversal patterns. In other words, most major trend reversals, which any reversal is some form of a major trend reversal, whether it's a wedge, head and shoulders top. A head and shoulders top is just a left shoulder, head, right shoulder. Here, the overall symmetry is bad, so I wouldn't call it a head and shoulders top. My concern here is this is not enough of a trend line break for a major reversal. It's kind of like this over here, even though it's hard to see it now, so I'm going to do this. So it's kind of like this right here, tight bull channel, trend line break to the moving average around around June of 2023. And then we had a strong rally up to here. This is a good example why a lot of traders do not like to sell in a tight bull channel right at the moving average. If you sell above a bar, you see what happened. You sell above this bar at 45.05 and a quarter, disappointed on the 27th. And then look at the low of this bar, 45.01. And that's why a lot of traders are not, whenever they're selling in a tight bull channel, they want to sell higher. But I think the market might do something like this, rally up to the highs, get a deep pullback, and then channel up, and then maybe get a deeper trend line break here. But this is not a major reversal. This is minor. So maybe if we rally and then sell off again, we'll get a major reversal. But right now, bears have not done enough. Okay, question. Al Brooks says he knows traders that win 90% of the time and rarely lose. I'd assume, including him. Does this mean that the 40 to 60% rule doesn't apply to them because they only lose 10% of the time? Yeah, good question. So the market is in a band of 40 to 60%. What that means is 40 to 60% is an extreme. So in a trading range, if you're selling at the high in a trading range, most of the time the market is at really close to 50-50. And if you think about, probabilities or statistics or even like a bell curve, most of the bars or data points are going to be pushed towards the middle. So if you have a trading range, let me go to a 5-minute chart because it'll be easier to see it there. So here's a trading range. In a trading range, selling anywhere right here or buying anywhere right here is a really bad idea because it's around 50-50 probability. If you're selling high in the range or if you're buying low in the range or selling high in the range, the probability is higher that you're going to get reversion to the mean. In other words, a pullback to the middle of the range. So that is what Al means when the market is 40 to 60%. Now, a general rule of thumb is And you're correct in a few things that you're thinking about. And I'm looking over here to read your question that's on the screen. But how can a trader be 90% profitable? Your question basically is how can a trader be 90% profitable if the best if Al says that the 40-60 rule, and let me restate your question in a different way. So how can a trader be 90% profitable and rarely lose if the and give me 1 second here. So the 40-60 rule basically states that 40% of the time you're going to lose. At best, no matter how strong your trade is or how great the probability is, there's a 40% chance you're wrong. And if you're taking a trade that's 40% if you're taking a trade that's at any trade, at best or at worst case, you have a 40% probability of making money. So that means no matter where you take a trade, worst case in general, it's close to 40%. Best case, it's 60%. That's true and not true. In other words, let's say I sell the close of this bar right here or this bar here. Yes, in general, as Al says, 60% chance the market's going to go all the way down here. But if I sell this close and I'm really quick to get out, what's the probability that I can sell this close if I'm disappointed by the follow through? I can scale in and get out break even. What's the probability right here? If I sell this close, disappointed here or here, that the market will allow me out break even? It's all the time. The market's generally pretty forgiving. Just look at any of these bars. If you buy here at the top of a trading range and you buy more above a bull bar, you make money. Even if you buy this close and scale in, you make money. If you sell this close, you still made money. If you sold the low tick right here or below this bar, scaled in, you made money. There's all sorts of ways to increase the probability of your trade. But what it comes down to is management. So the 40-60 rule, I mean, the reality is, if you're going to be, the reason that this question is worth mentioning is if you're going to be a scalper, you really need probability higher than 60%. Otherwise, 60% is pretty much break even on a given trade. So here's a probability spreadsheet. If your risk reward is 1 and you're 60% profitable, your return is 0.2. If you're going for twice your risk, so in other words, you're risking $1 to make $2 and your probability is 40%, your return is 0.2. But you can see both of these equal the same return. 0.2 is kind of marginal. It's kind of like minimum wage. And when you factor everything working against you, when you factor in commission, the bid-ask spread, slippage, human error, when you factor in all those pieces, this will basically give you a break-even strategy at best. So what traders have to do is they have to find a way to increase probability. The 75%, even 70%. They've got to figure out a way to do something like this. The problem with the above portion up here is things get very subjective very quickly. Because what traders end up doing is scalping out a lot of times when they'll scalp out often when for a profit that is less than their initial risk. Their actual risk might be really, really small. But if they sell this close and their stop's up here, they're not really putting a stop up here. They're just selling, putting a protective stop up here, and they're going to exit the trade if it starts to turn or do something that they don't want it to do or that they weren't anticipating. But what that means is their initial risk is relatively big. It might be somewhere up here, and it could be bigger than that because technically selling up here is not really a good area. But if they do sell, they might scalp out after these doji bars because when you get dojis in the bottom of the range in a sell to close market, usually it pulls back. And because of that, if they start scalping here, then if you sold this close and you scalped out, you maybe made 3 or 4 points, but your risk was maybe 10 points. And the reason I'm bringing this up, most traders should focus on this. Figure out how to get twice your risk. So in other words, take reasonable swing setups, figure out how to get twice your risk, and then go for swing trades. And then if you can, work on increasing your probability slightly, something like this, or even the 50% category. But to answer this question, it's very subjective. And what I mean by that is high probability trades have bad risk reward, which means you have to manage them. You have to know how to manage the trade. Okay, let me look at a few more questions. Okay, question. I have a hard time knowing when wedges, three push patterns are a good setup for reversals. Can you explain when is a good time to look for wedges? For what to look for wedges to get reversals, and how do you trade them? Yeah, so a wedge is a channel, and channels typically evolve into trading ranges. And the problem is, I get why you're asking this question because it's referring to today. The problem with markets is they're fractal. Smaller patterns make up larger patterns. And when you see a rally that's really tight, it creates a breakout on higher time frame. So when you look at this right here, let's just find a different example. Let's look at this wedge right here. 1, 2, 3, nested 1, 2, 3. Let's say you sell at 12.10. Well, selling at 12.10 is going to be basically selling this right here. Do you really want to sell when you have bear bars cannot make any money? So the problem is when the channel is relatively tight and you see a lot of open gaps and you look at a higher time frame and it's clearly trending, it's really dangerous to be selling here. Channels 75% of the time lead to trading ranges, and those trading ranges lead to breakout modes. And 25% of the time, you get an upside breakout. And you can argue 57 is that upside breakout. And this is really common in channels. But look to the left. Rally, we closed this gap. This gap stayed open right here. This gap stayed open here. So basically, what you got is a parabolic wedge here, a trading range. And the trading range, instead of leading to more trading range price action, it led to open gaps and then trend continuation. But when do you look for wedges? Back to your question. I like to see, you go to the 60-minute chart to answer it. For me, when I'm looking for wedge patterns to work, I want the market to be relatively in a trading range. So you can see kind of like something like this. This is a 60-minute chart of the ES.D, so the RTH, or the regular trading hours of the Emini. And you have a lot of bull bars closing on their highs here. And limit order bulls are making money. Whenever you get big bull bars closing on their highs, and even though the market's pulling back here, it tried to break out to the downside. So it tried to break out of a wedge here. But then, big reversal bar, bear bar, another big bear bar. But when you're getting all these reversals and traders are clearly making money below bars, and you look to the left and it's not clearly, it's breaking out below, but not all that clearly breaking out below. What I like to do for wedge patterns is wait for reversals. Now, the other thing you can do is wedge patterns are much better trend continuation patterns than trend reversal patterns. So what does that mean? In a trading range, looking for wedges is a great idea. The worst thing people do when they start looking for wedges is they start looking for wedges against a strong trend. And that's usually the worst thing you can do. So the best thing, or the most ideal thing, besides in a trading range, when you get 3 pushes up, you can look to sell because you're in a trading range, or when you get 3 pushes down. Not really a great example here, but something like this, 1, 2, 3, you're probably going to bounce. The other thing is looking for something like this. Strong rally, maybe 3 pushes down, 1, 2, 3. We're in a bull trend, so higher time frames bullish. looking to buy in this area makes a lot of sense. Okay, let me look for one more question and I'll wrap this up. Question for the trading room: what year of the month would you recommend purchasing? Yeah, if you want to, it varies. Any of them are good. You're asking specifically as far as Al through the years. I'd just pick a year. Pick 2019, 2018, 2020. Any of those years are fine. But the more important piece is spending a lot of time listening and studying the recordings and applying it to the trading course. So for tomorrow, I think we'll probably get a disappointment bar here and then a second leg up, but we will see. All right. Thanks everybody for listening, and I will talk to everybody soon.